Hello and welcome to this week's special presentation. My name is Jim Penna, Manager of Retirement Services here at VectorVest, and I'm very happy to be hosting this week's topic, which is titled Profiting from a Dividend Growth Portfolio. Last week, Angie's essay and Todd's special presentation were a great window into the power of using the basic foundations of the VectorVest system of stock analysis and market timing. I strongly urge you to read and watch both if you haven't already. They both focused on an essay from Dr. DeLito back from December of 2004 called VectorVest Simple. So I wanted to stick to the idea of applying the basic VectorVest analysis and apply it this week to building a dividend growth portfolio. My goal in this week's presentation is to extend that power to the creation of a blue chip dividend growth portfolio, and some of the adjectives we use to describe this type of portfolio is safe, steady, practical, and yes, in the most admiring way, boring. And for the retirement-minded investor, that's exactly what we're looking for. We'll begin with the fact that many investors mistake high dividend yield as the main characteristic of a quality dividend growth stock, and it's not. There are other factors that need to be considered. These are three of the factors we'll focus on in this presentation and how to use VectorVest to find and manage that portfolio. Number one is earnings growth rate. The concept is simple. How can a company continue to pay and grow their dividends if they're not making money? Next, we certainly want to be sure that the dividend is growing over time. There are many good quality stocks that have a long history of dividend growth, and we're going to do our best to find those. And then finally, dividend safety. And there's a lot of nuances that fall under that umbrella that I'll talk about, but dividend safety is another key characteristic of a quality dividend growth stock. So let's go into the program and we'll take a look. Now, last week, again, Todd did a wonderful job of talking about how to find high VST stocks right here on the homepage and discussing the power of VST, and we can get a lot of information here. Todd also talked about market timing, the when to buy portion, how to build and set up that portfolio. For now, I'm going to, again, switch gears here. I'm going to go to the Viewers tab and start here in this presentation by looking at the folder called Dividend Payers in our Watchlist viewer. And in the Watchlist viewer, I have it set here to the what's called the DRIP 25 plus years. That DRIP stands for Dividend Reinvestment Program. So all of these stocks, you're able to reinvest your dividends. Nowadays, it's very easy to do through your broker. And what we see here are stocks that have not only paid, but have grown their dividend every year for at least 25 years. Okay, Lowe's is at the top of the list. And as Todd talked about last week, relative value, safety, and timing. He talked about VST and comfort index. Today, we're going to talk more about the VectorVest analysis on the dividend portion of these underlying stocks. So here, I'm going to slide over a little bit. In fact, I'll break down our control panel there to give us some more room. And we'll focus on the dividend information that VectorVest provides for us. So looking at Lowe's, it is ranked by VST. So it is right now in the DRIP 25 plus, the highest ranked VST stock. But when I slide over here, we'll see these headers. We have the dividend, dividend yield, dividend safety, the dividend growth, as well as the YSG, or the yield safety growth vector. Much like the VST, we take yield, safety, and growth, and Dr. DeLito created the YSG on a 0 to 2 scale, of course anything above 1 being favorable. If I right click on any of these stocks and we go to the View Stock Analysis Report, remember you can get the details or the definition of all of our headers in our spreadsheet by scrolling down. If I continue to scroll down here, I just want to take us to the dividend area to show you where dividend yield, safety, growth, how we define them, how we arrive at the numbers. So there's some important information here, always can be found on the Stock Analysis Report. So here in the Watchlist viewer, you'll see we have several great watch lists for dividend candidates. I always start with the DRIP 25. We also have the 10 to 24 years. These stocks have grown and paid their dividends for at least 10 to 24 years. We also have 5 to 9. I won't talk too much about them tonight, but master limited partnerships, closed-end funds, there's ETFs and REITs. There's a lot of different candidates. There's also a list here for monthly dividend payers that you can use. We'll save that for another presentation, but for now, I just wanted to show those resources that you have here under dividend payers and a great way to find good quality dividend stocks. If I just go ahead and graph, say the top 10 here, I don't want to take too much time on the graphs because they're all going to look very similar. So if I bring the graph over to my page here, and I'll break this down, and I'm going to make these a 10-year graph on the stocks I want to show, and I could drag this out to 25 years and you're going to see the same pattern of these good quality stocks. So I have what I like to refer to as the golden staircase. This is the dividend payout and how it's grown every year for lows, again for at least 25 years. And you'll see the similar pattern on all of the stocks at the top of the DRIP 25 plus. Okay. T. Rowe Price, one of my favorites. I own that stock. West Pharmaceuticals, another great one. But you get the idea here on these type of stocks and what we're looking for in that dividend growth. So that's a good indication of the type of stocks we're going to look for. What I want to do next is go right into the Unisearch tool, and I want to show you a couple of different searches and then focus on one in particular and build an investment portfolio around it. So in the Unisearch tool, we see our search directory here, and we can go and start in the conservative folder, and there are some good dividend searches here. One of my favorites in this particular portfolio is pale blue chips, and you'll see the ability in VectorVest. If I drag this down a bit, we can see the parameters. Now the sort of the search is VST plus YSG descending, so it's taking into account both dividends and fundamentals of the stock. Relative safety has to be at least 1.25, and what I love about pale blue chips is that it addresses each parameter individually. So dividend safety, growth, yield all have to meet these certain parameters just to make the list. When we run the search, we'll see a list of quality stocks that come to the top of the list. Lowe's being right at the top. Cigna, KBH. So there's a lot of recognizable names here. What we're going to find are mature, well-established companies that make the list and the type of dividend stocks that we're going to be looking for. If I scroll over, you'll see that the dividend yield, safety, and growth numbers are all very strong. Dividend yield has to be at least 1% just to make this list. Okay, the dividend safety is the one indicator in the VectorVest program that is not on a 0 to 2 scale. This proprietary indicator is on a 0 to 99 scale. Then we have our dividend growth and the actual dividend paid, and then the YSG above 1 being favorable. So some great stocks come up here. You'll see a lot of high RS stocks, a lot of good quality stocks. So that's one that is a great search, a great place to start to find these type of stocks. There are others in the prudent folder. There is one that I like, USA's best growth and income stocks. This combines growth and income, which is a little different than what I'm about to show in just a moment. And what you see here is a relative safety number that has to be at least 1.4 to make the list. But when I scroll over, the dividend parameter is that the YSG has to be greater than or equal to 1. And all that means is that there is no parameter on the dividend yield that we're receiving. So if my main objective is going to be dividend payouts and income from dividends, while these are great stocks with great capital appreciation potential, the dividend yield itself may not be up to standard for the objectives, again, of a safe, steady income. Which leaves me down to the retirement folder, and that's going to lead me to blue chip dividend payers, the search here. Drag this up just a bit, and there's a good description of this search. It finds companies that pay a safe and growing dividend of at least 3%. In fact, the dividend payout in these stocks has grown year over year for at least 10 years, and in many cases much longer. Earnings growth rate and dividend growth rate are key to this search. The VectorVest system makes it very easy to sort these companies by growth rate and dividend growth, bringing the best candidates to the top of the list. And that was the goal here. Created this search about 3 or 4 years ago, and I wanted to keep it as simple as possible to use the power of the VectorVest system to give us the best blue chip dividend growth potential. Again, not just looking for the highest yields. And so I began here. The stock has to be part of either the Dow Industrials, Transports, Utilities, or the S&P 500. And the reason is larger, more established companies with more predictable profits are often the best dividend payers. So a lot of these companies you'll find are basic materials, oil and gas, banks, financial, healthcare, utilities, REITs, things of that nature, and that's the type of stocks that we're looking for. So the well-established, mature companies with strong free cash flow. Next, we do put the parameter of a yield greater than or equal to 3%. I only want stocks that have not only paid, but have grown their dividends for at least the last 10 years. And then finally, a very important factor is the stock dividend safety greater than or equal to 50, and I'll explain the importance of that in just a moment. It has a lot to do with the dividend payout ratio, and I remember speaking with Dr. DeLito when I created this, and there's ways to calculate dividend payout ratios as parameters here, and you can build your own, but I was struggling with it, and I was speaking with Dr. D, and he just said, James, just put a dividend safety greater than 50, greater than or equal to 50, and you'll achieve what you're looking for. And so when I run the search, I'll go ahead and break down the control panel so we can see these are the stocks that come to the top of the list as I'm recording here. And we'll take a look and we'll focus on the important factors. So again, relative value, safety, timing, VST is what Todd focused on last week and what Dr. DeLito focused on in VectorVest Simple, and they're all very important, of course, but again, I'm looking at a different objective here. I'm looking at allocating assets to generate a safe, steady income, and I'm going to illustrate that in just a moment. But as we come to the right of where these important fundamentals are, we'll see our dividend information. So we have a stock like Broadcom or Cardinal Health, Bristol Myers Squibb. These are all, again, very mature, well-known, more established companies. So just to make the list, we know there has to be a yield of at least 3%. The dividend safety, greater than 50. We do have a couple. This is a utility. EVRG is a utility. It's right at 50. Now here's the importance of dividend safety. What we want to be sure of in a quality dividend growth stock is that the company is able to continue to pay and grow their dividend. And the dividend safety number helps to ensure things like the comparison of either earnings per share versus the dividend paid. Another way to do it is earnings yield versus dividend yield. And what you'll see here is if you look at earnings per share on Broadcom, at $24.91, their dividend is $14.40. So they're obviously earning more than they're paying out in their dividends. Cardinal Health, DTE, they're all, if you compare earnings per share to the dividend paid, that ratio is fair and reasonable. You can also do it with yield, so earnings yield versus the dividend yield. The dividend yield being simply the dividend paid divided by the price of the stock. So in this search, the sort we use is earnings growth rate times dividend growth rate to bring the combination of those two to the top of this list. And then if there's any ties, I use the comfort index as the tiebreaker there. So many of you may be used to hearing me talk about relative safety and how important it is, and it is, of course, very important. But because we've changed objectives here a little bit, we're not really looking at our objective is not pure growth stocks here. We're looking for that well-established company, and so relative safety may not be quite as strong as we're used to looking at, again, for retirement-minded positions in our portfolio. But there is a reason for that. Again, dividend growth and earnings growth rate play a key role. So I'm going to use blue chip dividend payers to go ahead and walk through the process of actually building a portfolio. The first thing that I'll do is take us into the backtester and give you a little bit of history on blue chip dividend payers, how it performs. Now I've done this with many of the other retirement-minded dividend-paying portfolios, and quite frankly, I have a hard time finding any that perform better over time than the blue chip dividend payers. Now there may be certain points in time where one search may outperform another, and that's fine. The most important concept I want to convey tonight is that we are looking with a longer term mindset at how we invest for this dividend income. Right? So I want to see not only over 1 year how it performs, but I'll explain my 8-year portfolio here, which is as far out as we go. So I ran it first as a 1-year backtest using the profit locker stop criteria in our program. If I click here, I will go ahead and share the backtest parameters that I used. I always use confirm calls. I've run this using RT Kicker. I've run it using DEW. And again, with the objective of a longer term mindset, confirm calls always outperforms the shorter term. Okay, there may be sections where it might do better with a shorter term trade, but over time, the confirm calls works best. We're using blue chip dividend payers. Their profit lock is our setup. Let's go ahead and take a look, and I'll show you the stop criteria. Now, I use a 100% target. That is there just simply as the ability to allow the stock to run. And then we use a 15% stop, and in the profit locker, that means as the stock continues to rise, it reaches certain levels, and that stop criteria will ratchet along with the price of the stocks. And so that is a great way to do it. What I want you to take away from the stop criteria on any of whatever portfolio you decide to build or backtest is that we're simply going to use a prudent stop, prudent to conservative stop, and allow these stocks the ability to breathe. We don't want to turn it into a trading account. I simply don't worry as much about drawdown on my dividend portfolio because the objective really is to collect the dividends over time. Of course, I'm going to manage the portfolio, but I don't worry nearly as much about the drawdown on the overall portfolio. And as you'll see, we really don't have to. And so there's the blue chip dividend payers. That's the setup that I use. We're using just $1 commission just to get an idea of how many actual trades that we do. So let's talk about some of the backtests here. The one I will ultimately focus on is the longer term, but I ran one year earlier this week from April of 2020 to April 14th, which was this week. And listen, it's up 42%. The market is up very strong over that same time frame. This is not the kind of capital appreciation that I would always expect, but those are, again, well-known name stocks. Wonderfully, if you'd opened this portfolio a year ago, you're up 42%, almost 43%, and that doesn't include the dividends that I'm going to talk about in a moment that you collect. I also ran it for 3 and 5 years because we need to see that, right? Everyone wants to see the 3 and 5, and what you're going to see, and I'm not hesitant to show this equity curve, and we see in 2018 it held its own. It went underwater slightly a couple of times, but if you remember, and I know in this day and age 2018 it seems like decades ago, but if you remember 2018, in January and October we had 2 sharp sell-offs, and the S&P 500 was actually down in 2018. And so blue chip dividend payers held its own, paid us our dividends, and got us into 2019 where it performed really well. Obviously, we all know what happened in February of 2020. I won't go into details here, but in our retirement coaching group and in our course and in several strategies of the week in the past, we've talked about strategically defending your portfolio by buying insurance. In other words, the very simple trade of buying protective puts when the market timing signals indicate it's time to do that. And so we were able to mitigate this drawdown here that we saw in February of 2020. And then the portfolio took off once that market began to move again. As all of these back tests are the same in that they don't show the dividends that were paid out. The back tester doesn't automatically account for dividends. So you're still near double digits for the 5-year. You're in the teens here for return. Again, not including dividends. This one held up okay. Again, 2018 was a little tougher. Had a nice recovery. We like to see that. That's one of the good things we want to see. So I said earlier, the most important thing I wanted to convey is that we look at this in a longer term outlook. And so when we apply these quality stocks over time and allow them to grow, we've got a 186% return, again using that profit locker 100 gain 15 loss. So it's as simple as that. We've only got $136 in commissions with an annualized rate of return of 22.5%. Now, let me reiterate, this is the capital appreciation from our dividend portfolio. Okay, that's not even our main objective. We were able to generate in any of these time frames, 1, 3, 5, or 8 years. And if you're wondering why it's 8 years, I began this model back when we began our retirement coaching group, and it was a 5-year back test at that time that I converted into a portfolio and have continued to use that. I have several. One uses the Profit Locker Pro, one uses 100 gain 25% loss on the Profit Locker. In this case, I'm using the 15% on the Profit Locker downside. Just want to share the positions that are in here. Our worst performer right now was up 5%. Our worst performer was up 5%. That's Cardinal Health. And that's what that looks like. Those are the back tests. This is what we use to get a sense of the efficacy of our investment plan or our process system, whatever you want to call it. And so from here, what I did with this back test is I converted it. I simply, you click on convert and it gives you the choice to start with an empty portfolio, which you can do to begin a new paper traded account to track it. Remember, you'll want to edit your commission. Most places don't charge a commission anymore. Or you can continue from the end of the back test and continue to run it as a model portfolio, which is what I did, which is why this is 8 years now. So I saved it as a portfolio. Let's go into the portfolio manager now. The one I want to focus on, though, is the 8-year blue chip dividend pair. So I'll break that down. We are currently up in this portfolio 187, almost, I'm going to call it 188%, coming close to tripling the investment in 8 years. That's just capital appreciation. This began as a $100,000 portfolio in January of 2013. These are the current positions in the portfolio, all coming from the blue chip dividend pair search that I showed earlier. You can see Ameriprise getting ready to meet that 100% return on investment. If I continue to slide over just a little bit, you'll see our gain per share. And I want to come over to the dividend yield because what we'll see on dividend yield, now remember, just to make the list, it had to be a 3% yield just to make this list. Well, this yield is at 1.68, so how is it still on there? Well, remember, there is an inverse relationship between the price of the underlying stock and the yield. As the price rises, the yield will go down. It doesn't mean they cut their dividend, of course, and so the dividend remains a very strong $4.16, although the yield is lower because the price of the stock is higher. But these are the positions that are currently in there. These are the dates they began. And that is the portfolio. And I cannot emphasize enough that that is just the growth of the portfolio. So what about when we add dividends to it? Well, you can click Manage Portfolio. And if we turn off the genius here for just a moment, what you can do is each time you can track it. You could look at our graphs and you can see when the stock has its dividend payout or its X dividend date. If you own it on the X date, yeah, you are entitled. So you can add the dividends there by clicking on Manage Portfolio and choose Add Dividend Payment. You can put in the stock and whatever date the dividend was paid or the date it went ex-dividend, if you owned it, is fine as well. And you can put in the amount of the dividend so you can track that. Now, of course, the backtest can't do that. So what I did yesterday is actually go through and calculate the dividends that would have been paid out over this 8-year span. How did I do that? Well, if I go to reports and I go to trade history, I'll slide that over to the screen. You can see we have and I sorted it by symbol. We have every trade, every round trip trade that was done. So I have the life of every trade. I go into Yahoo Finance, I get a dividend history, and I calculated to the penny as close as I could every dividend that we were entitled to for the life of every trade. just to give you a sense of how I did that. And here's the spreadsheet, and it is it's pretty telling here what the power of these dividend payouts is. So starting with ADI, you can see the shares. I cut out from the trade history a lot of the columns. We didn't need them all, but this is the history of the portfolio. And these were the dividend payouts as they were calculated using Yahoo Finance as my source. And as we come down, we'll see, sometimes we held a stock for a very short period of time. HP, we didn't collect any dividends, whereas Kimberly-Clark, we were able to collect a ton of dividends. And you can see the numbers there. Now, as I continue to scroll down, these are the current 10 positions. And since we purchased those positions, these are the dividends so far that we collected. So just within the last year is when all of these positions are within the last year. We have almost, as you can see at the bottom here, almost $5,000 just from our current holdings. And if I click on the column, you'll see it's $40,538 that we've collected in dividends over the time frame. When we add those numbers here, we can see that our gains are even much better. And finally, what that doesn't take into account is the power of reinvesting those dividends, which I'm going to save for another presentation to show you how reinvesting and compounding that rate of return by reinvesting the dividends just creates even more income and more growth in your portfolio. And that's how we use the VectorVest program to help you build and manage a strong dividend growth portfolio.